Have you ever wondered how to generate weekly or monthly income from the stocks in your portfolio? If so, then this video is created just for you. Hi, Darren here, and I help investors understand how to use options to enhance their investment portfolio through YouTube. Today, I'll be talking about an option selling strategy known as the covered call. This is a common strategy implemented by many option sellers out there in the market to generate passive weekly or monthly income, and at the end of my sharing, I'll go through a case study of a covered call that I have done, as well as show you the exact steps in performing a covered call. The usual disclaimers: options can be risky and one can potentially lose more than the initial capital if executed wrongly. If you are someone new to options, I will always recommend learning the basics to options and paper trading first before using real money to trade. Before we perform a covered call, we have to understand the key difference between buying a call option and selling a call option. The buyer of a call option has the right but not the obligation to buy an underlying security, which in our case is a stock, at the predetermined price on or before a predetermined expiration date. This means that when you buy a call option, you pay premium upfront first, and you are now able to buy the said stock in the option contract at a predetermined fixed price on or before that contract expires. Naturally, the call option buyer will exercise this right when the price of the stock is higher than the stated price. Therefore, when you own a call option, you generally will notice that the premium of your option contract will go up when the price of the stock goes up. Now, the seller of a call option has the obligation to sell the underlying security at the predetermined price to the call option buyer on or before a predetermined date. This means that when you sell a call option, you will receive premiums upfront, and you have to deliver your shares to the option buyer at the fixed price should the buyer exercise his right. Therefore, when the call option seller has no shares on hand, he will have to buy the required shares from the open market and deliver it to the option buyer. This is known as a naked call, and it is extremely risky, as the stocks could go to the moon and you will be forced to buy the stock at whatever price the market offers. A safer alternative to selling a naked call will be to sell a covered call. This will ensure that in the event the call buyer exercises his right to the shares, the call seller will already have the stock and will not need to buy them at the current market price, hence the name covered call. In order to perform a covered call, the call writer, which is the one selling the calls, has to ensure that he has a minimum of 100 shares. Now you must be asking, why must it be 100 shares? This is because one option contract controls 100 shares. Therefore, in order to sell one covered call contract, the call writer has to have 100 shares to begin with. So why do people sell covered calls? The main reason would be to generate passive income. You see, when you sell a covered call, the premium you receive from selling the call is given to you upfront, and you can do this weekly or monthly to generate that much needed passive income for your stock portfolio. And secondly, selling a covered call can help investors set a selling price for the stock. Hence, if the stock goes above the sold strike of the call, then the stock will be called away at a profit. This allows the covered call writer to earn from 1, its premium, and 2, the capital appreciation from that stock. And lastly, selling covered calls also help you lower the cost basis of your stock. Just imagine, if your stocks do not get called away, then each time you sell a call, you are effectively reducing the cost price of your stocks. Of course, selling a covered call is not without its risks. In the event the stock were to get up, you will not be able to participate in the upside appreciation, hence capping your gains. In addition, should the stock drop in value, then you risk back holding that stock. Let us now go through a covered call position in my portfolio. So a few months ago, I sold a put on this stock called BWA and collected a premium of $4.10. As my strike was $50, hence I was assigned 100 BWA shares at $50, and my cost basis was $45.90, which is essentially $50 minus that $4.10 of premium which I got. So if you're unsure how puts work, do check my link at the top, where I go through in detail the basics that you need to know when selling a put. So now that I have 100 BWA shares, it is now time to lower the cost basis of that stock. So before I sell a call, I always like to know the general trend of the stock. I have a paid subscription to Market Club, and I use it to give me a gauge on the overall trend of the market and individual companies. Using Market Club, I can see that the overall trend of the market is currently directionless. And if I were to take a look at the trend score of BWA, then unfortunately, things are not looking good for the stock. It is on a downward trend with a score of a negative 90. Just my luck. In addition, the stock is below its 200-day moving average. Therefore, with all this information, I have decided to sell a call that expires on the 14th of April next year with a strike of $47.50. The premium that I will collect is $1.40. Hence, on the 14th of April next year, should BWA trade above $47.50, I would have earned $47.50 minus $45.90, which is $160 in total. However, should BWA trade below $47.50, then I would effectively have brought down the cost of my stock purchase to $44.50, which is $45.90 minus the $1.40 that I collected. I have not decided yet, but I might buy the close the sold call at 70 cents and sell another call to lower the cost basis further. Hi guys, let me now show you how to do a covered call on Thinkorswim. The first step will be to click your trade tab over here and find the stock ticker symbol that you want to do the covered call on. For my example, I'm going to do one on Ford and the ticker symbol will be F. In order to perform a covered call, you must first own the shares. So for this example, let's say I already own 200 Ford shares and I want to sell 2 covered calls that expires on the 18th of February. I will first head down to the 18th of February, open up the option chain, and select the strike that I want. Let's say I want the strike to be 21. I'll just go to the bid and click it. You'll notice a sell trade under your order entry. Since we are selling 2 contracts, hence ensure that the quantity is a -2. Once you change it to -2, click enter. Next, go to the price and select what price you want to sell it to. Let's assume that we want to sell it at a price of $1.40. I'll change the price over here, type in $1.40 and click enter. Next, go to the time in force and select if you want it to be a day trade or a good to cancel. I will recommend a day trade. Once this is done, click confirm and send and you're good to go. Now let's assume that you do not own the shares. If that is the case, the easiest way would be to go to the spread tab over here and select covered stocks. Assuming that we want to do a covered call on Ford with a strike of 21, but expires on the 18th of March, then all we need to do is go to the 18th of March option chain, open it up, find the strike that we want, which is $21, go to the ask and click it once. You will now see under your order entry, 2 orders, a sell and a buy order. If you want to sell 2 covered calls, then we need to change this -10 to a -2. Change it and click enter. You will now notice that the number of stocks will also change to 200. As you can see, the price will be $19.06 and this will be a debit. This is despite Ford being priced at $20.80. And the reason why is because the premium of the call has already been netted in. So now adjust the price to one that you're comfortable with. Let's say we just want to change it to $19. Then you just need to change this amount here to 19 and click enter. Next, go to time in force and select whether you want it to be a day trade or good to cancel. For this example, let's use a day trade. Lastly, click confirm and send. You will now notice a maximum profit of $400. This is the premium that you will receive from the calls. Review this whole order and click send. And that, my friends, is how to sell a covered call on Thinkorswim. I'd like to keep this video interactive. Type in the comments below on what stocks you feel are good candidates for selling calls on and why, and also please share other topics that you'd like me to cover. And if you found value in this video, please subscribe to my channel and smash that like button. See you!